Welcome to the Freedom Capital Management Strategies Quarterly Review and Market Outlook. I'm Brian Zabor, Investment Director. I'm here with Pete Murphy, Chief Investment Officer. Pete, it was another strong quarter for equities. Could you provide us with some of the key highlights?
Thank you, Brian, and thank you all for joining us today. It was a great first half of the year for global stock markets. And when we look back at the factors that drove the strong results, what's most notable to me is that we entered the year with a lot of pessimism and negativity. Most investors and economists entered the year bracing for recession that has not transpired. And most also were concerned about the challenges of last year, which drove stock and bond markets sharply lower. We had a really strong recovery this year as conditions ended up being better than most expected, which had set a low bar for markets, and stock markets surged higher because of it.
Thanks, Pete. Could you dig in a little bit more and provide some of the key drivers of the resilient economy?
When we look underneath the hood of what went better than expected in the first half of this year from an economic standpoint, two things stand out. The first is that economic activity has been surprisingly resilient. And what I mean by that is, as I mentioned earlier, most expected a recession this year because of the monetary tightening that took place last year. And so far, there have been no signs of recession. And when we look at this resilience in the economy, and particularly in the US economy, there's three areas that stand out. The first is the job market. The job market remains very strong and is showing few recessionary signals. Examples of this are continued gains in monthly employment and a high number of job openings per unemployed worker in the economy. So many signs of general health in the job market. The second area is consumer spending, which has remained strong and robust throughout this year. And consumers are not only supported by the strong job market, but they're also supported by savings that have been accumulated in recent years during the pandemic that they are now beginning to spend. And then third, the housing market has been surprisingly resilient. Most expected the housing market to struggle mightily because of higher mortgage rates over the past year. And while that has impacted housing activity, overall housing prices have remained strong and inventories remain low relative to demand. So housing fundamentals still are in a pretty strong place. The second key factor is moderating inflation. Inflation was the primary challenge that confronted investors in markets last year. And what we had was consistently rising inflation and central banks acting to combat that inflation through higher interest rates. And that led to financial conditions tightening and stock and bond prices falling. What we've had take place in 2023 is that inflation has begun to moderate and decelerate, which means that inflation is still high, but it's coming down. And the direction is more important than the magnitude for investors at this point in the economic cycle. And with that, that has taken some of the pressure off of central banks to continue tightening monetary policy. We recently saw the Federal Reserve pause their interest rate hiking campaign. And with that, financial conditions have eased. And because of that, we've seen strong gains in stock and bond markets in the first half of this year. So those are the factors that really drove the gains this year.
Those great insights, Pete. You mentioned the Fed is now on pause. However, if you look in the past, when the Fed is raised to this magnitude, the economy is usually tipped into a recession. Can you provide some thoughts around that?
Absolutely, and there's a lot of talk right now going around in the financial media around this possibility of a soft landing. And what I mean by a soft landing is it's a scenario where the Federal Reserve raises interest rates just enough to cool inflation and bring it back to its target levels, but not so much that it slows economic activity to a degree that drives us into a recession. And historically speaking, that has been a rare occurrence. Almost every time the Federal Reserve has raised interest rates, especially at this magnitude and pace, the economy has ultimately succumbed to a recession. And so when we look at the factors today and begin to ask ourselves, could this time be different? Can the elusive soft landing be achieved? There's a few factors in both directions, both supporting and detracting from that view. So we'll start on the one hand, the supportive view. When we look at the world today and the economy today, there are a few signs of current recession. As I spoke about, there are manifold factors speaking to resilience in the economy, from the job market to the consumer spending to the housing market and beyond. So on the one hand, when we look at current economic activity and conditions, there are a few signs that recession is coming, and the economy seems to have weathered the sharp interest rate increases over the past year. But on the other hand, there are several leading economic indicators that have been flashing red for much of this year. Examples of those include an inverted yield curve, which we've spoken about earlier this year, persistent declines in leading economic indices, more restrictive lending standards from banks. We spoke about some of the turmoil in the banking sector earlier this year. And then a slowdown in global manufacturing activity, which has been much weaker than the service sector this year. So on that side, we see a lot of factors pointing to, recession still does seem likely from a leading economic indicator standpoint. So we've got this real challenge. On the one hand, current conditions suggest strength, but on the other hand, we see leading indicators continuing to suggest caution.
Pete, it sounds like a mixed bag here. Ultimately, what do you think transpires?
In our opinion, history is a pretty strong precedent here, and we do think a recession will ultimately transpire. The question becomes when, and we believe that is a very difficult question to answer right now. So while we do think the monetary tightening will eventually lead to a recession, it is really difficult to predict when, and we don't believe it is imminent at this point because of the current economic strength. And when we look at some of the factors that are making it unusually challenging to predict the timing, and it's always difficult to predict the timing, but even more so today in our opinion. For example, a lot of the key economic indicators that I just referenced have been materially distorted by pandemic effects the last few years, and they've become more difficult to rely upon. They've been more unpredictable and volatile than usual. So many of the signals we relied upon in the past have become more challenged because of some pandemic effect. And then secondly, as I spoke about, stock markets have risen a lot this year. So investors have grown more optimistic. So some of the pessimism that I spoke about coming into this year earlier, a lot of that has dissipated, and there's more optimism among investors and markets. And with that, we feel more of the good news that's currently taking place has been priced in, which makes us somewhat cautious still looking forward.
Pete, those are great perspectives. In closing, could you leave investors with some thoughts about how to navigate the current market environment?
Absolutely. And as I spoke about, we are in uncertain times. And that's not an unusual state of events because the future is inherently unpredictable. But that said, there are important perspectives that we believe investors should keep in mind at all times, and especially so today. First is maintain discipline. Avoid the temptation to try to time markets. And this is important both when markets are challenged like they were entering this year, but also when markets are in a more optimistic state like they are currently. Staying disciplined, focusing on your long-term plan is incredibly important to navigating the inevitable ups and downs in markets. Second, stay diversified. In an uncertain economic environment where recession risk is elevated, as we spoke about earlier, one of the best ways to manage risk for investors in this type of environment is to stay diversified. And what I mean by that is not only looking to stocks as an allocation within portfolios, but also looking to other investments like bonds and cash. And in this environment, because interest rates have risen quite a bit, bonds and cash have grown much more attractive in terms of the yields that they are generating relative to the past decade. And that's something to consider as a compelling investment to help diversify portfolios alongside equities. Third, focus on resilience in your portfolios. And what I mean by that is companies that are going to stand the test of time and are going to be able to work through any economic challenges that may arise. And that would be companies that have strong balance sheets, steady earnings, a history of growing dividends. So focusing and emphasizing quality, we think makes a lot of sense in this environment. And then in closing, stay engaged with your financial advisor. Make your financial plan a living plan, and keep them apprised of any changes in your life circumstances so that they can update your plan accordingly.
Pete, thanks for all those wonderful insights. Thank you for joining us today. I hope you have a wonderful summer, and we look forward to updating you on the financial markets and economy in early fall. Take care.
Thank you.